I'd like to call to order this public meeting of the Commodity Futures Trading Commission to examine the trading of futures and options in the precious and base metals markets and to consider federal position limits and related exemptions within these markets. I want to first start by thanking my fellow commissioners. It's good to be all together. And the distinguished panelists that we'll be having here today. We look forward to hearing from a diverse group of participants about many aspects of the metals markets. Today's meeting builds upon the ongoing look that we as a commission have had in regulating futures and options and commodities on commodities of finite supply. Some, as you recall, last July and August, the commission had 3 open meetings to discuss the energy markets, and it was very informative and insightful. In January, the commission had a public meeting as well and voted out a proposed rule to possibly reestablish position limits in the energy markets, and also a rule concurrent with that bringing uniformity to granting exemptions in those markets. We continue to receive comment letters on that, and the public is encouraged, and interested members certainly, to continue to submit letters through April 26th next month. You can find the instructions at our website, www.cftc.gov. But in today's meeting, we turn to the metals markets, and the issues of position limits will be the central issue today, but actually the intent is a little broader than that, is to hear and discuss the many issues related to the metals futures markets. In particular, at least, I'm interested in hearing panelists' views on how the price discovery markets in metals work and how it relates to the cash markets as well. Interested in how the U.S. futures markets relate to the international markets in metals and the over-the-counter metals derivatives marketplace as well. And the panelists' views on differences between metals markets and energies markets. We sort of went in depth there, but to hear some of those differences. What significance does the fact that the metal markets are more concentrated than the energy markets mean? I'm also interested in the role of hedgers and speculators and exchange-traded funds and index funds in the marketplace. So I look forward to hearing all of the panelists' views on this, and certainly their views on one of the central issues today, on whether we should reestablish position limits in the metals markets, and if so, what those limits would look like, and whether, most importantly, whether they'd really promote the integrity and efficiency of the markets, which I think is the core mission of the CFTC. If they were reestablished, what formulas might be used? Might they be similar to what we proposed just a month or 2 ago in the energy markets, or have been used in agriculture, or something else? What type of exemptions might be appropriate, if at all? So I look forward to hearing from everybody and getting and benefiting from the diversity of views. I think I'm supposed to say also that on this hearing, we're also leaving and encouraging the public to submit comments by April 30th, 2010. I think that there's a way to do that, which is metalshearing@cftc.gov. And if I can read it, it's metalshearing @cftc.gov. But with that, I was going to turn to see if any of my fellow commissioners have just a little opening statement. Commissioner Dunn.
Thank you, Mr. Chairman, and I commend you for having these meetings. At the last one that we had on position limits in energy, we had a Latin lesson. I see today we're going to get a lesson in Greek. So I'm looking forward to hearing from the panelists. It occurs to me that there was a great deal of effort that went in for all the panelists that provided stuff for us. It gave us a good deal of background reading. I appreciate that. The mission of the CFTC is twofold. It's to protect market users and the public from fraud, manipulation, and abusive practices related to the sale of commodities and financial futures and options. And 2, to foster open, competitive, and financially sound futures and options market. I hope today that our panelists will be able to shed some light on how the metals markets are currently working and whether the CFTC is fulfilling its mission to keep the markets open, competitive, and free from unlawful conduct. Over the last couple of years, some market users have raised concern that certain metal markets may not be free of abusive trading practices. When I first heard of these concerns, I asked our Division of Enforcement to examine the allegations of wrongdoing, and an investigation was opened and is still underway. Now, usually we don't tell folks when we're doing an investigation, but former Chairman Lucan did make that announcement that we were looking at a particular metal through an investigation. While we have not yet completed this investigation, I think it's important to remember that trading in the futures and option market is a zero-sum game. For every winner, there is necessarily a loser. Several of today's panelists and market users have written the Commission in support of the implementation of position limits in metals markets. With potential position limits in the energy markets, I am concerned that position limits in regulated futures markets without corresponding limits in the over-the-counter markets may result in less transparency in our markets if those presently trading on exchanges move to over-the-counter and other opaque markets to circumvent CFTC regulations. I'm very interested in hearing from our panelists their thoughts on this particular concern. I look forward to hearing from this diverse group gathered here today to speak. I look forward to a lively, robust, and educational discussion. I appreciate the efforts of the Commission staff has put into this meeting, and I would like to thank the panelists for appearing today. Your time and efforts will be instrumental in helping the Commission to better understand how the metal markets are operating. My commitment to you is to listen with an open mind to your thoughts on this subject. I thank you in advance for your participation.
Thank you, Commissioner Dunn. Commissioner Summers.
Thank you, Mr. Chairman, and I want to thank all of you for being here today at this public meeting to examine the trading of futures and options in the precious and base metals markets. I'd like to thank, in particular, Commissioner Chilton for his leadership in this area. This has been an area of public interest since he and I came to the Commission in 2007, and I think that this is an appropriate time for us to look at these markets as we're considering position limits in other commodities like energy, that we also examine the metals markets. I also want to thank the chairman for holding another public meeting. We've had a number of these public meetings during his chairmanship, and I just want to reiterate how beneficial I think that these meetings are, not only to us at the Commission, but to the public, the general public that is interested in these futures markets, to understand the complexity of the issues that are surrounding, excuse me, issues like position limits. These are important issues, and we have a lot of things to consider when we are considering these limits. I'm also grateful to all the panelists. I think we have a very diverse group of people testifying today, and I'm very interested in hearing more about these important issues. Thank you.
Thank you, Commissioner Summers. Commissioner Chilton.
Look, you all know my history on this issue. I support position limits in the metals complex to prevent and deter manipulation and stop excessive speculation. I think it's a professional-grade regulatory tool that we need to protect consumers. And I hope this hearing helps put us on a fast track to getting a proposal out there. Thanks.
Thank you, Commissioner Chilton, and I do thank you, as Commissioner Summers said, for your leadership on this issue. Commissioner Amalia.
Thank you, Mr. Chairman, and I'd like to thank all the panelists for their participation, especially the CFTC staff. I've now been a commissioner at the CFTC for the past 6 months. It has been a very busy time. In particular, since I started in October, I've received countless emails from participants in the metals markets. Today's meeting acknowledges that the Commission has heard the concerns of the market participants. Therefore, I am pleased that we will have a public meeting to receive information from this diverse group involved in these markets. Based on my initial review, it is clear to me that the metals markets are uniquely global in nature. One must acknowledge this as the starting point for any well-rounded discussion on the subject. The United States, and more pointedly the exchanges registered with the Commission, are not the market's epicenter. Significant price discovery in these markets takes place abroad in London. After all, it is the only location for the London fix for gold and silver. Just as NYMEX's WTI contract provides the benchmark for global oil prices. In short, these markets are complex and involve diverse players with diverse objectives ranging from hedging manufacturing operations, maintaining central bank reserves, speculation on prices, and of course passionate retail investors. Therefore, any analysis of these markets and any actions by the Commission must take into account the global nature of these markets. We must ensure that any rules or regulations do not offer any opportunities for regulatory arbitrage or decreased transparency of U.S. markets or any other markets, forcing activity to less transparent trading. I would like to thank the staff and the Commission and the members of the panels for their hard work to represent the Commission with their testimony and responding to our questions. I also appreciate the hard work of the Division of Enforcement, the Division of Market Oversight, and the Office of the Chief Economist to support our investigation into metals markets. I look forward to a well-rounded discussion today. Thank you.
Thank you, Commissioner Malia, and all my fellow commissioners. I'd like to, our first panel, our General Counsel, Dan Berkowitz, our Acting Director, I like to say Director, of our Division of Market Oversight and Surveillance, Steve Sherrod, who've both done an excellent job in preparation for this hearing, but have testified so many times before, it seems that you're repeats here, and you'll be at the next hearings too, guys. But I didn't recall which order we're going to do this in. All right, so General Counsel Berkowitz, please. And if you can try to keep it, a little bit brief, but you're full, to the public listening and to people in the audience, they're full. Presentations are going to be on our web, or are they up? They're apparently already up on our website, so that's good. So, Dan.
Thank you, Mr. Chairman and Commissioners. I will provide a short history of position limits in the futures markets for metals commodities. Since 1936, the Commodity Exchange Act has directed the CFTC to establish such limits on trading as it finds, quote, are necessary to diminish, eliminate, or prevent such undue burdens on interstate commerce that result from excessive speculation in futures markets for those commodities. After the passage of the 1936 Act, the Commission set position limits for wheat and other grains. Later, the Commission established position limits for cotton and several other agricultural commodities. Over the next several decades, for some of the commodity futures that were not traded on federally regulated exchanges, such as the livestock commodities, the exchanges set their own position limits. In 1974, the CFTC was created and its jurisdiction expanded beyond the agricultural commodities listed in the CEA to include futures contracts for any commodity. At the time, there were no position limits for any of the futures contracts for metals. In adopting the 1974 amendments, the Congress highlighted the need to regulate the futures market for silver. The Senate Agriculture Committee urged the Commission to conduct hearings on, quote, the proper speculative limit for silver futures trading, unquote. The Conference Committee urged the Commission to, quote, regulate effectively futures trading in all commodities, including silver, immediately on the effective date of this act, unquote. In the following years, the Commission studied and deliberated as to whether and how to establish position limits for the new commodities in its purview. In 1977, the Commission considered but decided not to adopt position limits for the silver markets. The crisis in the silver market in 1979 and 1980, precipitated by the Hunt brothers, became the catalyst for the Commission's proposed rule in late 1980 to establish position limits for all commodity futures. At one point during the crisis, two groups of traders, the Hunt brothers and Conti Group, held long positions in the March 1980 silver futures contract amounting to 122% of the total silver stocks in licensed depositories. In 1981, the CFTC adopted a final rule to require the exchanges to establish position limits for commodities that were not already subject to Commission-set limits. Prior to 1993, the Commission used several criteria to establish the levels of the single month and all months combined limits. These included the breadth and liquidity of the cash market, the financial exposure of traders in the event of limit price moves, and the extent to which limits would constrain trading. In 1993, the Commission adopted an open interest formula for determining position limits. The formula provided that the combined futures and options speculative position limits for both a single month and for all months combined be set at 10% of open interest up to an open interest of 25,000 contracts, with a marginal increase of 2.5% thereafter. The Commission also permitted exchanges to establish position limits based on this formula. In 1992, the Commission granted an exemption from the position limit requirement to permit the CME to use position accountability for several of its financial contracts. Position accountability levels were not fixed limits, but rather levels that would trigger a further review of a trader's position. 6 months later, the CFTC determined it would also grant requests to permit position accountability to be used for highly liquid energy and metals contracts. In 1999, the Commission issued a rule that formally recognized the practice of position accountability in months other than the spot month. Also in 1999, the Commission formally adopted a rule requiring that the spot month speculative position limit be no greater than 25% of the spot month deliverable supply. Previously, since 1981, the Commission had applied this rule as a matter of administrative practice in reviewing applications for a designated contract market. The Commodity Futures Modernization Act of 2000 statutorily authorized the use of position accountability. The CFMA did not alter, however, the Commission's mandate or authority in Section 4A to establish position limits as it finds are necessary. I'll now turn to a description of the metals commodity position limits. The first position limits for silver futures contracts were imposed by the Chicago Board of Trade in October 1979, as an emergency measure during the Hunt silver crisis. And you can see the silver is the black line on that chart that goes all the way back to 1980. You can see that's the first one, and that was imposed in late 1979 during the Hunt crisis. The COMEX imposed emergency limits in January 1980 during the crisis. In April 1980, the Commission approved permanent speculative limits for the silver futures contracts at the CBOT and COMEX at the same levels that had been imposed by the exchanges during the crisis. These limits at the COMEX were set at 500 contracts for the spot and next month and 2,000 contracts for the all futures months combined. The CBOT's limit was set at 600 contracts in any one future or all futures combined. In August 1984, the CFTC approved amendments permitting the COMEX and CBOT to increase speculative position limits for the silver futures contract to 1,500 contracts in the spot month and 6,000 contracts in the single month and all months combined. And you can see the black line on that chart jump up in 1984 when that increase was approved. In 1992, the CFTC approved amendments to COMEX rules replacing speculative position limits with position accountability standards in the non-spot months for the silver futures contracts. The accountability levels were originally set at 7,500 contracts, but have since been reduced to 6,000 contracts. The spot month speculative position limits remained at the same at 1,500 contracts. And you can see in the metals markets moved to accountability levels in the 1980s, where the energy markets did not move to the accountability levels until the 2000s after the CFMA. But these were imposed in the 1990s. I think I said 1980s. I meant 1990s for the accountability levels. The silver and gold futures contracts that were formerly traded on the CBOT are now traded on NYSE Life. The NYSE Life silver and gold futures contracts have fixed position limits rather than accountability levels for individual months and all months combined. But the fixed position limits are numerically equivalent to the COMEX silver and gold futures contracts accountability levels. In 1983, speculative position limits were established for the COMEX gold futures contracts at 3,000 contracts for the spot month and 6,000 contracts for single month and all months combined. And you can see gold here is on the red line. The gold is on the red line on these charts. As with silver, the COMEX in 1992 replaced speculative position limits with a position accountability standards for non-spot months in the gold futures contracts. These were at 7,500 contracts. Again, like silver, the accountability levels for gold were later reduced to 6,000 contracts in 1994. The other commodities are on the chart: copper, platinum, palladium. We can detail those if necessary. Also, we have a chart on the exemptions and the spot month limits, showing exactly what those were. There are a number of exemptions from the spot month position limits have been issued in the gold, silver, and copper markets. 5 traders have been issued exemptions as of February 26, 2010 for gold, 5 for silver, and less than 4 for copper. Don't have the exact number for that. And that concludes my statement. Be happy to answer any particular questions.
Sorry, why don't we hold our questions until Steve Sherrod gives his presentation. But I thank you, General Counsel Berkowitz.
Well, thank you. This morning I will present 2 sets of information regarding gold, silver, and copper. The first set's a summary of trading volume in select markets during 2009, and the second set of information provides a view of large traders and concentrations in those markets during a sample period of 2008, 2009, and through this year to about a week ago. The information comes from our aggregate statistics from our large trader reporting system, and by way of reminder, Section 8 of the Commodity Exchange Act does not generally permit the Commission to publish data and information that would separately disclose the business transactions or market positions of any person. As the Chairman mentioned, gold, silver, and copper are traded around the world on many different exchanges. Gold price discovery occurs around the world, and in 2009, for the cash, forward, and futures markets in 6 different major markets, the London Bullion Market Association accounted for about half of the trading volume. The LBMA is a market that trades spot cash and short-dated forward contracts. It is a commercial market in that they trade participant to participant, but they do conduct a central price discovery process every day that's called the daily fix. It occurs twice. There are 5 participants. They hold a conference call, and during this conference call, they reach out to their customer base. The chair starts the price discovery process. Each of the 5 participants, on behalf of their customers, enters orders to sell and buy. If there's a general match, the price is fixed. If there's an imbalance, they continue moving the price until there's a relative balance between the buys and sells. So that's about half of the volume in 2009, moving through both the spot and forward markets at LBMA. COMEX accounts for about 1/3. Turning to silver, in 2009, 5 venues, 5 of the leading venues that traded silver, COMEX accounted for about half of the trading volume, and the LBMA accounted for about 1/3. These volumes, by the way, are equalized in terms of ounces and not in terms of number of contracts. Turning to copper, in 2009, the London Metal Exchange accounts for over half of the trading volume. The Shanghai Futures Exchange accounts for over 1/3, and COMEX accounts for only a sliver of the world volume when we measure this in terms of tons. The second part of the data that I have for you today is aggregate data, as I mentioned. These are for the U.S. reporting markets that we collect data through our large trader reporting system. To provide transparency to the public, the Commission publishes, in the form of a Commitment of Traders report, aggregate statistics based on Tuesday's open interests for markets in which there are 20 or more traders. The graph that we see here is gold on a net futures and options combined basis by traders. The trader classifications are: the green line is the producer, merchant, processor, user. the red line for swap dealers. Money managers is the blue line, and other reportables that are traders that are non-commercials but have positions above the reporting level is the purple line. And you can see from the gold net futures and options combined, the largest shorts are in the producer merchant category. Turning to silver, that pattern repeats. The largest shorts are in the producer merchant category. And then turning to copper, generally that pattern repeats. And again, this would be for COMEX, for copper trading in the U.S. Another way that we provide transparency to the public is through the Commission's bank participation report that's published on a monthly basis. Because we publish this on a monthly basis, we include data less frequently to the public than the weekly commitment of traders. We publish the bank participation report where there are 5 or more banks in the market. These are divided into 2 categories of U.S. banks and non-U.S. banks. If either one of those categories have less than 4, then we do not publish the count of banks in the category. In general, you can see from the light red bars, the leading short participants in these markets are U.S. banks. I'll look briefly at silver. You can see the same pattern. And then I'm going to skip ahead for a few slides. These are again on our websites. And I want to look at an overlay of the commitment of traders in the bank participation report. And this is an example of how one might use the reports together. And what I've done is I've replicated the bank participation report. And I've showed 4 red bars for each report, typically, because the BPR only comes out monthly. And it's been widely inferred and reported that there was a dramatic increase in short open interest amongst banks in August of 2008. However, you can see from the 4 categories in the commitment of traders, there's not likewise a jump in any one of these categories, and likewise there wasn't a significant change in open interest in the marketplace. There are some alternative explanations that are plausible, and I'll offer 2, and again, I can't comment on the specifics. One would be that the change in short open interest could have occurred because of a reclassification of a trader in a category from a non-bank to a bank. Another would be because of a merger or an acquisition where a bank assumes the position of a non-bank entity and they're both in the same category. We also provide data to the public, quarterly call currently, and we're going to move to a monthly basis, a special call. In general, the special call data shows that the metals part of the index investment activity in the swap market is small in comparison to the energy markets. The last set of data is a quick look behind the public disaggregated commitment of traders data. This has otherwise not been revealed to the public. The summary of traders at or above position accountability levels for that sample period of the last 2 calendar years through March 16th. That's 115 different Tuesdays. And you can see quickly for gold, there were 56 different unique traders in all months combined that had a position over, and the maximum number on any one day was 26. We've graphed some of this data and provided it in the documents that we've released on the website. For the top 4 owners, the net long positions, you can see here the top line is for copper, gold is yellow, and silver is in silver colored. We've graphed for comparison purposes wheat and corn on the Chicago Board of Trade, S&P 500 on the CME, and the energy commodities using the format from the reference energy commodity proposed rulemaking earlier this year. And you can see from the next chart, which are short positions, that the largest concentrations on the short side of the market are in copper, gold, and silver. And with that, I'll note that this last bit of data is at the owner level, not the trader level. So we've consolidated all traders that are owned by a common entity. be happy to answer any questions.
I thank both our panelists. Excellent presentation. Again, for the public, you can find these 25 charts and the other presentations on our web. I'd just like to ask the General Counsel a couple of questions and maybe one question for Mr. Sherrod. But to the General Counsel, a question that's come up and it's been discussed by some of individual commissioners or CFTC staff that may come up at this meeting. I note that some of the statements submitted by panelists today include some specific allegations regarding market manipulation in the metals market. And so I'd like to hear from you to what extent it's appropriate for the commissioners or the CFTC staff to discuss these types of issues at this meeting at this time.
As you've noted, Mr. Chairman, the purpose of the meeting is to examine the trading of futures and options in the precious and base metals markets and to consider position limits and related hedge exemptions on CFTC-regulated facilities in those markets. As the CFTC's rules recognize, it is generally inappropriate for the Commission and its staff to publicly discuss the details of any possible enforcement investigations or in this or any other area. The Commodity Exchange Act also prohibits the public disclosure of any information regarding individual positions or particular market participants by name. Accordingly, this particular forum is not appropriate for the discussion of specific allegations of misconduct by specific parties, and is not what the Commission contemplated for the meeting.
So in light of these restrictions on matters that the Commission may address in a public forum, I think it's appropriate for me as chair to request that the Commission and the staff and witnesses, when you're on the other panels, refrain from discussing specific allegations against specific parties. So,
Well, point of clarification, Mr. Chairman.
Please.
I mean, I understand if we're not in a, we can't comment on our investigation, and we don't want to jeopardize any of that, and so we may not want to ask questions, but are you saying that witnesses can't say what they want about these issues?
well, I look to the General Counsel's direction, but I think that witnesses
It's sort of an integral part of this whole issue.
refrain from discussing specific allegations about specific parties. There are other venues to do that.
But we're
with our
not
Division of
censoring
Enforcement.
but we're not I'm sorry, I don't mean to interrupt.
There are other venues to do that with our Division of Enforcement, I think.
We're not censoring our witnesses' testimony.
No, I don't think I'm suggesting that in any way.
Okay, that's all. Thank you.
I'd also like to ask the General Counsel, if you might, to comment upon a statement that was in the testimony submitted by the CME group today. Hi, Jerry. But in the testimony, which I think is being presented by Mr. LaSala on our second panel, the CME states that in order for the CFTC to impose position limits under the Commodities Exchange Act, that the Commission actually is required to, quote, to find, and this is from their testimony, I understand, to find that, one, there is, in fact, excessive speculation or that it is likely to occur in the metals, and two, position limits are necessary and will diminish, eliminate, or prevent the burdens of such speculation before it may impose position limits. No such finding has been made, therefore imposing limits would exceed the Commission's statutory authority. I think I quote from their testimony. So I'd like you as General Counsel to this Commission to tell us whether you agree with their interpretation of the Commodities and Exchange Act. Does the Commission have to make a finding that, in fact, there's been excessive speculation in order to impose position limits?
Thank you, Mr. Chairman. First of all, I would just note as a factual matter that the purpose of the hearing is to gather information. No findings have been made. But in the abstract, whether a finding would be necessary, an actual finding that there has been excessive speculation or an actual finding by the Commission that there have been particular undue burdens, our interpretation of the Act is that a specific finding that there actually has been excessive speculation is not the necessary predicate for imposing the position limits. But I would add that that's not just the current Office of General Counsel's view. That is the view that the Commission has actually adopted, and the Commission has stated as the basis for its rulemaking on position limits. The rulemaking I mentioned in my testimony in 1991, where the Commission determined that the exchanges should have position limits for all the commodities that did not already have Commission-imposed position limits, such as the agriculture commodities. This issue was specifically raised in that rulemaking proceeding, and the Commission specifically addressed that very issue that a number of commenters had raised, a very similar comment back in the 1981 rulemaking questioning the Commission's authority. At that time, I just quote briefly from the previous rulemaking, the historical and current reason for imposing position limits on individual contracts is to prevent unreasonable fluctuations or unwarranted changes in the price of a commodity, which may occur by allowing any one trader or group of traders acting in concert to hold extraordinarily large futures positions. This regulatory philosophy is a well-established precept underlying the Act. From the earliest days of federal regulation of the futures trading industry, Congress recognized that position limits could be an effective regulatory tool to prevent disparate market fluctuations. The commenters raised the very same comment in that rulemaking, that the Commission hadn't made the actual finding that excessive speculation has caused these burdens. The Commission's response was the Congress has made the finding in Section 4A1. Section 4A1 represents an express congressional finding that excessive speculation is harmful to the market, and a finding that speculative limits are an effective prophylactic measure. So Congress has said that the position limits already are an effective prophylactic measure, and gave the Commission the discretion when the Commission says we believe these particular position limit is appropriate to as a prophylactic measure. In many of the rulemakings, I haven't gone through every one, in the 1990s and subsequent revisions on various rulemakings, the Commission has included a very similar statement that the Congress has found position limits are an appropriate preventive measure, obviously in advance of some harmful excessive speculation into the commodity markets. Also in the 1981 rulemaking, the commenter said, you haven't demonstrated these particular levels are actually the levels that are absolutely necessary to prevent excessive speculation. And the Commission had basically the same response, that we do not, the Congress has set up a scheme where the Commission has to find they're reasonably necessary. You don't actually have to prove that the specific numerical levels. Finally, I would add, I think as you noted in your earlier comment, Mr. Chairman, when we're talking about, for example, in the context of energy and metals, we're talking about reestablishing fixed Commission-set position limits. This would essentially take it back to possibly to the situation where it was in the 1980s before we had position accountability. But currently, under the same regime, under the same statutory authority, there are spot month limits and there's position accountability. The spot month limits and the current position accountability levels derive from the very same authority that we're talking about here. So those do not have those specific findings currently either. So we believe that there is adequate authority.
All right. I thank you, and I apologize to Mr. Sherrod, but I'm going to hold my question and turn to my fellow commissioners. We do actually have this little red light thing that we're trying to do this in 5 minutes, but Commissioner Dunn.
Thank you, Mr. Chairman. Don't worry, I'll give Mr. Sherrod his fair share. It's tough following the chairman because he asked some of the questions that I was going to ask. So I don't know if that speaks well of you or ill.
It just means we're a good team, Mike.
Okay. Mr. Chairman, I would note that in the briefing books that the staff gave us, there is an excellent chronology of speculative position limits for COMEX and NYMEX on the physically delivered metals futures contracts. If that is not on the website and there's no proprietary information in there, I would certainly hope that that could be put on the website as well so the public would have access to that. I think they would find that very helpful, looking at that entire history that our Chief Counsel began to enumerate.
Was that a yes?
That is in the longer written statement, plus it's graphically displayed in the
So is it, if
PowerPoint.
it's not yet on the website,
should
you'll
be,
put it
should
on there?
be.
Thank you.
Mr. Shard, we're talking about the 4A that the General Counsel elaborated on, and it again, the CME contends that the Commission doesn't have the power to set position limits unless there is, in fact, excessive speculation or it has likely to occur. That's the prophylactic side of what you were talking about, Mr. Berkowitz. The statute loosely defines excessive speculation as that which causes sudden or unreasonable fluctuations or unwarranted changes in price. Mr. Sherrod, has DMO seen this type of fluctuation or change in the metals market?
Once again, you ask tough questions. The price of metals has been quite volatile, particularly in 2008, and I would respectfully decline to comment. As you mentioned, there is an investigation underway.
I would have preferred a simple yes or no. On page 13 of your written testimony, you go through the summary of traders at or above positions accountability levels in there, and you enumerate the single month, all month combined for gold, silver, copper of what's happening there. Please tell the Commission and the audience here, what does DMO do when someone exceeds their accountability level, and what does the exchanges do, and is there any definitive written guidelines or is there a codification of how we interact with an exchange when we observe this?
We do, in DMO, we use our large trader reporting system, and we began gathering data on traders through a special call, and we provide the trader with the Form 40 and gather information on the traders far before they reach the position accountability level. We monitor their positions on a daily basis through the large trader reporting system in DMO. When a trader does their position equals or exceeds the position accountability level, the exchange automatically gets the consent of the trader to get information, and that would include traders that are non-members. If the trader is so ordered by the exchange, the trader is not allowed to increase their position further, or the exchange could order the trader to reduce the position, and that's without declaring an emergency. On a regular basis, surveillance staff in DMO and surveillance staff in the reporting markets share reporting information and surveillance activities. So we do work hand in glove with the exchanges.
Is that codified in any agreement with the exchanges?
It's not codified in agreement, it's a working practice.
So in essence, you're telling me all of these when they went over the position limits, all of these were in effect sanctioned by the CFTC, is what you're telling me.
On page 13, we discuss the position accountability levels, and the traders don't need any particular authority or approval from either the exchange or the CFTC to exceed the position accountability levels. On the other hand, for the spot month, which are hard limits, the exchange has shared their exemptions with us that Dan shared. There currently are 5 exemptions in each of gold and silver, and there are fewer than 4 in copper, and we have those specific exemptions that we get on a regular basis from the exchanges.
Again, my question here, let me zero in on this, because you're telling me that DMO is monitoring this on a real-time basis and that when you observe that someone has gone over an accountability level, not even before the position limit on the spot month, that you take actions on it. That tells me that, in effect, you have sanctioned what's going on. Am I being misled on that?
I want to try to be very clear. When a trader equals or exceeds a position accountability level, DMO surveillance staff does not do anything in particular. The exchange gathers information from the trader. It's their rule book that allows them to gather additional information. We've gathered information from the trader at a much lower reporting level when they exceed the reporting level. And as the exchange gathers information, we can obtain information that the exchange has. But we don't do anything necessarily when a trader equals or exceeds the position accountability level.
My time has expired.
So to clarify, it's really the exchanges that work with these accountability levels. We're aware of it, but you're saying DMO, this agency doesn't do something. I think that. Commissioner Summers?
Thank you, Mr. Chairman. I'll continue on the same sort of line of questioning with Mr. Sherrod, and if maybe you could give us an idea and the public an idea of what a trader, what would justify a trader having these positions over accountability levels?
The trader doesn't have to justify a position above a position accountability level. Their justification is only required when they're seeking an exemption from the spot month limit. That's the hard limit.
And to get those exemptions, if you could give us some examples of how traders justify those exemptions.
There are a variety of exemptions that would be available. The most typical example is for a bona fide hedging position, consistent with Commission Regulation 1.3Z2, where the trader holds a cash position in gold or silver, for example, and would take a short position in the futures contracts to hedge the price risk of holding that physical inventory.
Thank you.
Thank you, Commissioner Summers. Commissioner Chilton.
Mr. Berkovitz, you mentioned Mr. Sherrod mentioned the bank participation report, but I wanted to ask Mr. Berkovitz, our counsel, about it a little bit. We have this dual issue that we have to balance, where we have Section 3, which says that we should promote price discovery, and then we have 8E of the Act that says that we can't reveal any individual trader. This decision to not list all four, concerned me, and it wasn't something that the Commission as an entity made a decision on. I'm not an attorney, so I can't talk about litigation risk. Everything else tells me that making this less transparent, this report, was not a good thing. But can you explain the sort of legal reason why you've chosen to do that? I mean, and again, maybe this doesn't factor into it, but particularly at a time where we're talking about doing something on position limits, and where if we've learned anything from the financial fiasco of the last several years, it's that we need more transparency. So I'm just curious why we did this on a staff level, change this report.
The statutory, you correctly referred to the statutory section, Section 8A, that prohibits the disclosure of positions or business transactions. And the statutory provision that prohibits the Commission from disclosing those it's not a balancing test. It's would it tend to disclose or not. And so we did not, in reviewing whether what limits could be placed on, or whether there should be limits, or what information is appropriate to release, there's a certain boundary that the Commission's can't cross. It's not a balancing test, and so we looked at it strictly for that purpose.
Okay, thank you. So, Mr. Sherrod, I mean, doesn't it tell you that it's so large that it's going to reveal who the trader is, that maybe that should pique the Commission's interest? I mean, by the nature of having to make such a decision, doesn't that tell us that maybe there's an issue here that the Commission should consider?
I think the answer is yes.
Okay, I'll accept that. All right, so I want to, you can comment later if you want, Mr. Sherrod. So one, I want to commend you for your presentation. We are privy to these sorts of presentations all the time by you and your staff, and they're very good and professional. Sometimes I feel like I'm a little, like that song says, blinded by science, but today it was very good, and they're always very helpful. I was particularly pleased to see your accountability level chart, and what it shows, and what Commissioner Dunn and the Chairman and Commissioner Summers are saying is, you know, they're ineffectual. I mean, they don't know. I've said before, they're like speed limits on a dark desert highway. There's nothing to be done. And I think we should do something, which is why, in my view, we need mandatory, hard cap position limits. If you go over them, you're in violation. If you continue to go over them, then there's some sort of action. There's a fine or a punishment or something. I don't know what that level is, and that's one of the things I'd like to ask some of our witnesses later about. I am curious, Mr. Sherrod, about a lot of people write to us, and people will talk about it later today, about the physical side of this. I know that we look at the physical side to some extent, but the shortages that people have talked about, and then I'm going to let you talk, but the second part of my question is, over the last couple of years, and before you were in this position also, I've given individual emails, some that actually forecast that the market in silver and in gold will plummet, that it's going to happen, and they'll say, look at 9 o'clock. Paul Kaplan, Andrew McGuire, and others have said this sort of thing. So I wonder if those have been helpful, and if you can give a general characterization without getting into any specific example that may jeopardize anything that the Commission is doing. But if you can generally characterize if those have been helpful and how you've looked at them. So 2 questions, the physical shortage and the examples that we've been given by individual traders that have been looking at these markets for years and years. Thank you.
I'll turn to the second one first. I always welcome comments from the public that would like to draw our attention to a particular matter. We investigate